Michael Jordan said, "If you run into a wall, don't turn around and give up. Figure out how to climb it." In the period, we've had to wade through the global and local economic challenges that we have had to operate our business in. We released our mid-year results today to June 2022 on the back of this crisis, having to contend with double-digit increases in municipal and utility costs, coupled with increased periods of load shedding and a weak consumer environment facing an increased inflationary burden, which remains a catalyst for downside pressure. As a counter to the current economic backdrop, we are encouraged by the continued positive momentum that we see in the recovery of our property portfolio. As a retail-focused REIT, our retail assets are driven by quality tenancies, providing the biggest share of uplift in the period. This has been supported by an encouraging recovery in our hospitality assets that are starting to show increased levels of activity. The positive momentum has been supported by the lifting of the national state of disaster and the removal of the remaining COVID-19 regulations, which contributed to a return in both retail and consumer confidence, boding well for our portfolio in the first half of the year. Delving into the key operational highlights, we see the following. We saw strong recovery in retail operational metrics, with our portfolio foot count up 10.2% on the 2019 comparable period and 28% on 2021. Our portfolio consistently experienced double-digit growth in foot count, having not dropped below 10% this year. This is due to our customer experience initiatives in place across our malls. We've seen an improvement in retail turnover growth, which is up 16.1% on 2019 and 25.1% on 2021. In the first half, we achieved 13.6% in turnover on Q1 2019, tracking some 25% ahead of Stats SA's industry benchmark of 1.9% year-on-year for the first quarter 2021. Trading gained momentum as the year progressed, with turnover in Q2 up 18.4% on Q2 2019. This encouraging start to the year contributed to better occupancy rates and good leasing activity in the period, indicating the strong demand for L2D retail space, where 179 leases, which includes renewals and new deals, were concluded in the first half of the year. This equates to 46,992 square meters, and our retail occupancy is now up to 97.2%. The portfolio occupancy level declined marginally to 92.9% in June 22 from 93.7% in December 21, with continued pressure in the office sector. L2D's office exposure does, however, remain very low, making up only 3.1% of our overall vacancy. Though not yet positive, we are seeing an improvement in the downward trend that has plagued rental renewals over the last few periods. Rental reversions across the portfolio were negative 16.3%, with retail renewals reverting at 15.6% negatively and offices at minus 26%. In June last year, retail was at 26.6%, so you see a big shift, and offices at negative 21%. It is worth noting that there is a time lag between turnover improvement and improvement in lease renewal rentals, which are also dependent on the timing of the expiry of the in-force leases. We have seen notable recovery in average hotel occupancies, with Sant & Son at 71.5% compared to 39.8% in the same period in 21, and the Garden Court now at 40.7% compared to 12.8% in 2021. Our in-force escalations for our leases remain healthy at 6.8%. L2D's balance sheet strength remains a key enabler in navigating this tough environment, with a loan-to-value of 24.64%. We have sufficient liquidity to meet our operational needs and remain well within our banking covenants. Our interest cover ratio is healthy at 3.18 times. Environmental sustainability within our ESG framework is key to our business. We have placed continued focus on implementing our bold commitments to achieving our net zero 2030 targets. We have therefore in the period successfully diverted 84% of waste from landfill from 35% in 2021. We are certainly on our way to achieve our net zero waste readiness by the end of this year. In terms of achieving our net zero energy target by 2030, we have invested in solar energy to reduce our reliance on the power grid. As at the 30th of June, we are pleased to have achieved a reduction of 3.6% across our portfolio with our latest solar roof plant installation at Promenade Mall. We continue to maximize our reduction at Eastgate and Midlands Mall as well. From a financial overview perspective, what has been very important to us is to ensure that we continue to enable future growth through prudent financial management, recording an increase in net property income by 10% to 272 million, supported by lease income escalations and improved activity in the retail portfolio and the hospitality assets. We are encouraged by the recovery in the hospitality sector, which has seen increased occupancies at both the Sandton Sun and Garden Court hotels, with net revenue up 14 million from the prior year. Operating costs are higher than the comparative period in 21 at 7.1 million, but our efforts to reduce costs are ongoing. Our conservative balance sheet is a critical strength within this uncertain context. We maintain a healthy loan to value at 24.64% at 30 June and sufficient liquidity to meet all our operational needs. Taking into consideration that property is a long-term investment, our teams continue to make considerable efforts to maximize on the operational gains to ensure it translates into distributable income. We have quality fundamentals in place with strong assets, and we continue to take the necessary measures to proactively address all challenges, contain costs, while strategically positioning the business for sustainable value creation. Our commitment to investing in our portfolio of quality assets underpins our financial and operational performance. Therefore, on the back of the solid performance, the L2D board has declared a full interim distribution of 17.48 cents per share, a double-digit increase of 11% over the prior year, which is reinforced by a strong balance sheet. While the South African economy remains under pressure with a low growth forecast for the remainder of 2022, we remain realistic about the uncertainties which prevail and focus on building the momentum gained in the first half of 2022. I want to express my sincere gratitude to the Liberty 2 Degrees team who have continued to give their best during this period of volatility. Your everyday efforts has made these results possible.